Hello everyone, and welcome to today's Corporate Tax Residency Seminar at Post-BEPS and in the COVID era. This seminar is brought to you by Taxand Cyprus, Zepos and Yannopoulos, Taxand Greece, Crido, Taxand Poland, Taxhouse, Taxand Romania, and Pepeliaev Group, Taxand Russia. We will discuss today corporate residency issues through a practical case study which involves 5 countries. Before we begin, please allow me to make some housekeeping notes and take you through. First, we would like to hear from you, so please do submit any questions you might have in the Q&A box on your screens, as you can see, and we will address your questions at the end of the presentation. 2, the presentation used in today's webinar will be available post-event. 3, speaker profiles and info can be found on the last slide of the presentation, but if you have any specific queries, please email taxand@taxand.com and you will be directed to the appropriate contact. So, if I may, I would like to start this webinar, this panel discussion, as we call it. We thought to do it as a panel discussion to promote direct communication with our audience in a practical way. That's why we are using a case study today. So, if I may start, I would like to explain you a bit about the case study and introduce you what we're planning to do today. As you can see, there is a Cypriot company that holds subsidiaries in Greece, Russia, Romania, and Poland. The Cypriot activities is holding company, as you can see, so is financing activities and IP activities. In each scenario, as you see, there's going to be different shareholders and directors. For example, in scenario 1 will be shareholders tax resident in Greece, directors tax resident in Greece, and in addition, directors from Cyprus in the Cypriot company. In scenario 2 as well, there will be directors from Russia, tax resident in Russia, shareholders from Russia, and in addition, Cypriot tax resident directors. And we follow as well for the other countries. So, what is this case about, and what is the purpose of our discussion? We would like to ensure that this Cypriot company is resident in Cyprus. That's the scope and the target of the discussion. So, by looking at each scenario, we want to understand the issues if the shareholders and the directors are non-Cypriot resident and obviously are residents in those countries that you can see here. Last point with this case study, we assume that the shareholders spent much time, more than 180 days in the year 2020 in Cyprus due to COVID restrictions. So this is the case study. I will now hand it over to Christos that he can explain the Cypriot implications, and then the other colleagues from Taxand, they will speak about their national implications from this structure. Christos.
Many thanks, Demis. Next slide, please. Going to the Cyprus tax implications. Next slide. Next slide. Next slide. So, thank you. Let me welcome you to this multi-country webinar. From a Cyprus tax perspective, let me set up the scene from an international tax perspective. There are globally, from an international view, 2 types of corporate residence test. The one is the corporation test, that is a more objective test, I will say. And the other one is the essentially management test, which is more a subjective test. In Cyprus, we have the management and control test that is in our domestic legislation, that is the essentially management test, whereas we don't have the incorporation test in our domestic legislation. However, there is a bill now under the parliament that we're expecting the bill to be ratified as soon as the new parliament is ready. So eventually, in the next couple of months, we will have the incorporation test as well. Next slide, please. Now, what does this mean in practice? It means that since we don't have the incorporation test in Cyprus, the mere fact that the company is incorporated in Cyprus does not automatically mean that it's a Cyprus tax resident company. On the other hand, because we have the management and control test, another practical example that we usually have here is that take, for example, that a BVI company or a Seychelles company or a Cayman Island company, they have the management and control in Cyprus. This may happen is that if, for example, the majority of the board of directors of that offshore company, they are tax resident in Cyprus, they take the decision in Cyprus, this company effectively will be considered as a tax resident in Cyprus, and the result will be that there will be tax on its worldwide income whenever arising. Now, how you solve such dual resident problems? Usually, you look at the tiebreaker rule of the OECD model that we widely used in Cyprus, the place of effective management test. Next slide, please. Now, the first point is that we need to determine what management and control is in Cyprus. Regretfully, the Cyprus tax authorities nor the jurisprudence in Cyprus, they don't have predetermined criteria of what management and control is. However, because we follow the common law jurisprudence in Cyprus, and because the management and control test arise from the UK, we follow UK decisions, like, for example, the Beers leading case from 1906, coming up to more recent cases like the Wood and Holden case in 2006, that eventually these cases, they say that you need to look the high level of decision making. So the top board, the high level of board, will effectively decide and clarify whether the management control is exercised in Cyprus. Now, turning to the problem that we faced, we have discussed before about the dual resident problem. Next slide, please. Is that we need to have a look also to the tiebreaker rule of the OECD model, which is the place of effective management. If you go through to the OECD commentary, you will notice various tax resident criteria that the OECD recommends that the two tax authorities, they will investigate in order to decide which is the winning state and which is the losing state. And from our experience, the most important one that we see in practice is that you need to have a look to the senior day-to-day management. And why the senior day-to-day management is important is because it doesn't overlap, it's not in line with the high-level decision that we are advising clients in order to have management control in Cyprus. Next slide, please. So this is a practical problem that we are advising our clients, is that assume, for example, that you have a Cyprus company that has its management and control in Cyprus. Well advised that you need to have the high level of decision in Cyprus. However, this multinational company has also another board or also takes decisions in another country. So you also take the senior day-to-day decisions elsewhere in the other contracting state. So according to the domestic law of the other contracting state, the company is resident there. So you have a dual resident company according to the domestic law of the two countries. Going to the tiebreaker of the OECD model, because the day-to-day management of this company is not in Cyprus but is in the other country, most probably the tiebreaker rule will assign the residency of this company to the other contracting state. So the other contracting state will be the winning state and Cyprus will be the losing state. So in this example here, is that Cyprus, although you have the high level of decision in Cyprus, you will end up being not treaty resident in Cyprus, and then you will lose your access to the Cyprus tax treaties. So to conclude my presentation is that we always, for corporate tax residency purposes, we always look the other country. So from a practical point of view, we look always the other country tax residency criteria for two reasons. First, to avoid being tax resident in the other country. And second, even if you consider to be tax resident in the other country, in case you claim the tiebreaker rule of the OECD model, then Cyprus will be the winning state and not be the losing state. Many thanks, and let me give the stage to my presenter from Greece.
So, thank you, Christos. From a Greek standpoint, the Greek Income Tax Code provides 3 tests in order for a legal entity to be considered as a tax resident in Greece, namely the place of incorporation or establishment, the place of registered seat, and of course, the place of effective management for any period during a tax year. To be located in Greece. Greek rules provide also certain indicative criteria in order for the Greek tax authorities to determine whether the effective management of a legal entity is exercised in Greece on the basis of actual facts and circumstances, taking mainly into account the place of exercising the day-to-day management, the place of taking the strategic decisions, etc., but also, interestingly, the place of residence of the majority of the shareholders or partners. As you can see, these criteria are in line with the relevant international standards and guidelines of the OECD and the EU directives. Notwithstanding these rules, there are also certain explicit exemptions in the legislation to the effect that although there is exercise of administration in Greece, nevertheless, the place of effective management of a foreign company is not challenged, as is the case with alternative investment funds, with Law 89 coordination centers and shipping. Slide change, please. Further to the above, up to date, the Greek tax authorities have issued very little guidance on substance in general, meaning not specifically on this matter. Connecting in essence substance with the physical presence, with the existence of equipment and premises. It is interesting to note that in 2020, the Greek tax authorities issued clarifications in relation to tax residence and permanent establishment issues in order to address the extraordinary circumstances created by the COVID pandemic. The guidelines did not shed any particular light on the effective management criteria in specific, as they focus on addressing, or better, in disregarding, the physical presence of individuals in Greece due to the travel restrictions. However, there is an interesting key takeaway as regards the overall tax residence criteria, pandemic issues set aside. These have to do with the place of adoption of decisions and the place of residence of the persons that participating in decision-making bodies. Another takeaway to stress is the fact that legal entities should be able to prove by any appropriate means their tax residence, keeping a record of facts and circumstances relating to their business proper. Slide change, please. So, moving on from theory, in practice, these explicit effective management factors mentioned previously have been introduced in domestic tax legislation recently in 2014, which means that any progress in terms of tax audit approach and, if any, jurisprudence would be expected in the following years. Also, as mentioned, the practice is rather limited. Tax audit focus has usually been on permanent establishment and TP assessments. There have been certain cases of exchange of information requests to foreign tax authorities, but these were more on the anti-abuse rules or the beneficial ownership concept direction. So, most likely here, the question that arises is more general. How much substance would a holding entity holding the shares of operating subsidiaries in Greece would require for all tax purposes, especially, for example, it is merely a passive holding, receiving passive income, rather than a management company. There are, of course, ramifications to the answer of this question, extending beyond the reclassification from a Greek perspective of the holding company's resident as such, as Greek. After all, following the new participation exemption regime in Greece, which exempts from taxation dividends and capital gains income, the reclassification may not have significant impact in case of passive holding entity participating in EU companies. But in a nutshell, this ramification could, for example, be the application of withholding tax, the non-exemption from withholding tax on dividends payable from the Greek OPCO to a foreign holdco, the denial of application of tax treaty benefits, and potentially also the imposition of tax in respect of capital gains and dividends coming from non-EU subsidiaries. In any event, and going back to the tax residence issue, in an effort to summarize what we discuss here from a Greek perspective, it should be possible to support the tax residence of a passive company abroad, based, of course, on all facts and circumstances involved, and as long as one gathers the evidence that the entity actually exercises its shareholders' right at the holding company jurisdiction and, of course, outside Greece. In any case, it remains to be seen, of course, how these matters will be dealt with in the future. And considering also the recent and important, in my view, European Commission's communication on business taxation for the 21st century, which includes plans to fight the abusive use of shell companies, meaning companies with no or very little substantial presence and economic activity. So let's see how this progresses in the future. And now moving on to my colleague from Poland, Paweł, the floor is yours.
Thank you. Good afternoon, everybody. And the next slide, it's already there. Okay, thank you. So Poland, I would say, is on one hand quite simple and on the other hand quite complex. And I will try to explain this briefly. Why it's simple? Because we just have a simple rule saying that we treat someone as a Polish tax resident if their company is registered there, I mean here in Poland, or if it has a management board in Poland. It's actually the law does not refer to the effective place of management, but the local law says management board in Poland. Following this should be filtered or looked through also in the context of the treaties, and then of course there is an effective place of management, and most of the Polish treaties, or if not all, most of the, let's say, European Polish treaties have reference to effective place of management. And this rule regarding the residency itself is so far has not been heavily used for any reclassification of the residency from foreign into Polish based on the let's say, well, effective place of the management. I will come back to this a bit later as well. But what is important is this limited tax liability which we have, and it concerns passive income, typical passive income, I would say, dividends, interest, royalties, but also relatively non-typical passive income like specifically intangible services, or in some cases real estate companies. And here the rules regarding actually not residency as such, but eligibility to use the treaty protection, so lower rate or directive exemption, are quite strict, and the topic is quite hot. Next slide, please. Yeah, so starting since 2018, Poland is introduced a new requirements to apply a reduction on the withholding tax, and this actually brings into light the discussion about the residency, but in a slightly different context than we are to discuss today. But still, I think quite important, because this sooner or later will transform into discussion about the residency as such in the context of potential dual residency. At the moment, due to the changes in the withholding tax rules, the focus is very much on the beneficial ownership status, which quite awkwardly in Polish definition includes also substance requirements. So actually, when checking eligibility for lower withholding tax rates, the Polish remitters, Polish company making the payments, must check the beneficial ownership status and substance, which actually in some cases leads to a discussion about dual residency. But so far, rather focus was on the simple fact whether we can apply the treaty protection or not, let's say, concluding whether we have, for example, Polish residency or a different residency for a Cyprus location or another holding location. Next slide, please. In the context of, let's say, specifically of the issues we are to discuss today, we indeed have at certain moment a bit more of discussion, a longer discussion about dual residency for foreign companies, usually Cypriot companies, by the way, which were set up by the Polish individuals and actually managed and run by those individuals still in Poland, to the extent that they had full power of attorney, full access to the bank account, and actually Cypriot directors did nothing. And in this context, the Ministry of Finance even issued a warning, official warning, saying that such entities will be treated as a Polish residents. And then, of course, treaty protection will be denied. But two important comments in the context of our discussion. This was the cases to which the ministry referred were really, let's say, I would say, obvious for any international tax expert or tax analysis. Let's say the situation was far more obvious than the background which presented at the beginning of our discussion. And also, there are not so many real cases when tax authorities challenge the residency of the foreign taxpayer. So far, the focus of authorities was always also withholding tax issues. We had a number of successful tax audits when the treaty protection was denied for, let's say, financing entities mainly, which were set up to provide back-to-back financing, and such cases were quite popular. And those cases brought into light the discussion about the general substance of the foreign companies. But as said, and repeating again, still dual residency is there is less focus on dual residency. It's far more about the treaty protection and denying treaty protection. And I'm sure we'll be discussing the background in our panel discussion later on, and then we can come back to this. And for the moment, it's all about Poland, and we can go to Romania. Thank you. And next slide.
Thank you, Paweł. Next slide, please. Well, for Romania, the tax residence status of a corporation is also similarly with the other states determined on different criteria. The main one is the same as Christos mentioned. We look at the place of incorporation. So if we are to look in our practical example, the Cypriot holding entity would be, based on this criteria, would be deemed to be a resident of Cyprus from the Romanian point of view. But we also have what is called the place of effective management test, based on which this Cypriot holding company may be deemed to have the place of management in Romania, with the consequence, obviously, that it will be regarded as a Romanian tax resident, having a full tax liability here, with tax currently at 16%, and it would owe this corporation tax on its worldwide income. Romania had a recent change in the place of effective management definition, actually starting right this year, 2021. It mainly focuses on the two conditions that you see listed on this slide. So one of them is that, for instance, the Cypriot entity in our example may be regarded to be a resident in Romania if the economic and strategic decisions necessary for managing its activities are made in Romania by the executive directors. Looking at it textually, let's say, it may not seem that friendly for the Romanian tax administration, because in practice what this means, it means they may challenge this only in the case where those decisions are made in Romania by the directors themselves. We know, however, that most of the times in practice, the decisions are formalized rather as being made in Cyprus by the directors which are appointed there. However, as this is a rather new definition, as we said, we will see how this will be applied in practice by the Romanian tax administration. The second condition that may be met in order for considering a foreign entity to be tax resident in Romania is that at least 50% of the executives are tax residents here. This again, it's a condition which in practice might not necessarily bring much on the table of the Romanian tax administration, because again, in practice, those foreign entities appoint directors which are resident in Cyprus, let's say in our case, so not in Romania. Next slide, please. Anyways, what can happen once a company, a foreign company, has the place of effective management actually taking place in Romania? There are two possibilities. One of them is that this Cypriot, let's say, Cypriot entity comes voluntarily to the Romanian tax administration and says, I meet the conditions of being considered a tax resident of Romania. So coming and asking for tax residency certificate from Romania. And there were cases where foreign companies have done or have taken this approach in order for them to eliminate probably some risks that they were aware of, and actually by becoming a tax resident in Romania, they in fact obtained the access to the double tax treaty network of Romania, which is around 90 treaties, and also they obtained access to the application of the EU directives. The other alternative is that the tax administration makes a challenge and attacks the foreign company and consider it has the place of effective management in Romania, and tries to demonstrate this in order to treat it as a Romanian tax resident and obtain the right to tax it on its worldwide income. Next slide, please. Now, in our case, if the Cypriot entity will be the holding company, if it will be regarded to be a resident both in Cyprus and in Romania as well, due to the place of effective management being considered in Romania, this problem should be sorted out most of the times based on the double tax treaty which is entered between the two states. So based on this rule, the so-called tiebreaker rule, generally the residency issue is determined by looking at the place of effective management. So in our example, if this takes place in Romania, it means that Romania will be the winning state and it will obtain the right to tax the Cypriot company for the worldwide income. However, what we wanted to point out here is that in a rather limited number of cases, and we identified only 3 tax treaties which are entered by Romania. So under those 3 treaties, instead of the place of effective management, the treaty says that the tax residence should be determined based on mutual agreement of the two states. So actually the tax administrations in Romania and Cyprus should discuss and reach an agreement on who will have the taxing right over that particular corporation. The problem with this rule is obviously that in case no mutual agreement is reached, unfortunately, that particular entity will not be able to enjoy the treaty benefits from this perspective. And this means that it may be considered at the same time to be a tax resident in both jurisdictions and be liable to tax there. So if any of you have in your structures at the same time companies from Romania and either Bulgaria, Italy or Norway, you should have this aspect in mind as well when you analyze the level of substance in your structures and so on. Next slide, please. What happens in Romania in terms of practice? So far, we will say that this is rather limited. No challenges were identified so far in terms of requalifying the place of effective management. However, looking at the tax rules, at least, we can think of three alternative approaches that the Romanian tax administration may adopt in practice. First of them is that, as we said, they could reconsider that the Cypriot entity has the place of effective management in Romania, and hence it will tax its net profits in Romania at 16%. A second option that we can think of is that the Cypriot entity could be disregarded from the structure, like you will look through it, and you will tax any payments, let's say, that were made from Romania to the Cypriot entity as if those were made directly to the individual shareholder, which is above the holding company. And you will apply the tax treatment specific to the individuals in our specific. And the third option that the tax administration may have is that they may consider the particular transactions which take place between the operating company and the holding, or the entire structure in itself, as being rather artificial, or otherwise said, being put there only or mainly for tax treaty benefits. And the consequence in this case under the Romanian law is that they will be able to deny the application of all the tax treaty benefits or the benefits of any EU directives. Of course, out of those three potential approaches, the Romanian tax administration will probably do a cost-benefit analysis and will choose the approach which will bring the highest level of income to the state with the least cost involved for them. This will be it for my part of this discussion. I will pass now to Andrey from Russia.
Thank you, Adrian. Good afternoon. Dear guests, I am actually continue our intellectual tax marathon. Russia is the last participant in that competition. Actually, as in other states in Russia, we also have the specific rules on the place of effective management. They were adopted, introduced into the national legislation about 6 years ago. Before that, Russian practice was based with respect to this matter only on the provision of the double tax treaty, and actually never any real developed practice with respect to the place of effective management existed before introduction to the tax legislation such specific national provision. Well, the Russian legislation also allows for the foreign entity to be recognized as the Russian tax resident under the voluntarily procedure. Then it applies to the tax authorities and on the criteria of the place of effective management in Russia is recognized itself as the Russian tax resident, or alternatively, the tax authorities may, let's say, reassess its tax residency status from the foreign states into the Russian Federation, basing also on the recognition, the place of effective management for such foreign company as being located in Russia. In both cases, the Russian tax resident, the foreign company which would be recognized as the Russian tax resident, become fully liable, let's say normal taxpayer in Russia, liable for corporate income tax and for any other related national taxes under the national legislation. So with respect to the, let's say, key criteria for the place of effective management, in Russia, for instance, compare with example of Romania, which just Adrian commented, we have, let's say, more subjective criteria. So the first one is that the executive office is regularly performs its activity on the Russian territory, or the main executive officials of the foreign organization mainly perform their management functions in Russian Federation. So this means that in any case, such criteria is made on the basis of comparison of the volume of activity performed in Russia and performed in the foreign states. So this is the first aspect. The second aspect that from perspective of the Russian national legislation, we have to compare not any day-to-day management activity of the foreign company, but only that type of activity which is performed by the official executive officials or office of the foreign company. For instance, if the Cypriot entity under its corporate documents has the highest executive official as the general manager, so we will have to compare how these general management functions are performed in Russia and in Cyprus, and on the result of such comparison to establish there would be the place of effective management. If, for instance, the Cypriot company has certain executive management board, has also the, let's say, another or under the corporate documents, the single official body, executive body of such Cypriot entity, then we will have to compare the functions, the volume of the functions performed by this board on the Russian territory and on the territory of the Cyprus. Next slide, please. Meantime, the national tax legislation established certain type of activities which in any case should not give rise to the place of effective management on the Russian territory or on the territory of the foreign states. So the tax code defines this list of activities. These are the preparation and issuing of the decisions by the shareholders meeting, preparation of the meeting of the board of directors, so some specific preparatory activities, as you may see. Then management and control activities performed with respect to this foreign entity, but by the Russian related or affiliated company or by the Russian affiliated individual on the Russian territory. And the last type of the activity, which should not also create the place of effective management on the Russian territory, would be control and management on extraction operations performed by the foreign company outside of Russia, if such control and management is done on the Russian territory. The next slide, please. Meantime, there is, let's say, another also, let's say, look on this matter, on the matter of the place of effective management as it is defined in the national tax legislation. And this approach, it's certain, let's say, pre-assumption in which cases the foreign company would be recognized as the foreign tax resident unless under some specific criteria, which I already comment and would comment further, it is not, it would be, let's say, reclassified on the status of its tax residence on the Russian territory. But again, as a certain pre-assumption, the legislation says that if the foreign company uses its own personnel who work on the territory of the foreign state, which is the state of its official registration of such foreign company, plus such foreign company uses the assets located on such foreign states, also on the state of its official foreign registration. And the third, if Russia has the double tax treaty with such foreign state, so under these circumstances, such foreign company would be regarded as a general approach as the non-Russian tax resident. The next slide, please. And also the Russian tax code somehow has the attempt to solve the potential issue of the dual tax residency. For instance, if on this high-level criteria, which I commented in the beginning, I mean the volume of the functions of the official executive bodies of the foreign companies performance in Russia and in the foreign states. So we come to the conclusion that potentially such company may have the tax residency in Russia and in its state of official registration, like in our example in Cyprus. The national tax legislation defines the second level criteria, which we also need to test in order to make the final conclusion what would be the ultimate place of the tax residency for such foreign company. And that legislation defines the following criteria. These are first, the state, their accounting and management operations of such foreign companies are performed, or the state there, the office administration is performed, or the state there, operational management of the personnel of this foreign company, I mean HR functions, is taking place. So these are as I said, the second level criteria which are applicable in case of dual residency, potential dual residency, as the Russian national legislation proposed to apply them in order to define what would be the place of the tax residency of such foreign company. And the next slide, please. Thank you. Here I just briefly summarized. We will further discuss these aspects with respect to all participating countries in the panel discussion. But here just some brief comments. How the existing practice in Russia is developing with respect to the place of effective management. Actually, so far the tax authorities, they are applying more, let's say, limited approach. They are mostly not trying to reclassify the place of effective management, the place of the state of residency of the foreign company from the foreign state into Russia. They make more, let's say, simple exercise. They are just, let's say, disregarding the status of such foreign company with respect to certain passive income paid outside of Russia to, let's say, to Cyprus, if it would be, as in our example, for instance, a financial company, or potentially maybe certain dividends distribution to the headquarters. So then, also based on the criteria of the lack of substance, they would disregard the application of the double tax treaty relief to such recipients. This is obviously more simpler exercise for them, because you do not need to compare this activity of this foreign company from the Russian side. It's enough to establish the lack of such activity on the side of the place of such foreign entity incorporation. But meantime, they're already just limited, but still some case law. Then the tax authority try to reclassify the place of effective management of the foreign entities, in particular of the companies from Cyprus or EVI, into the Russian residency. So this is how the current practice is developed in Russia with respect to the place of effective management issue. I'm passing word back to my colleagues. So this is all for from the Russian perspective that I want to discuss, and now I think we shift to the panel discussion. Thank you.
Andrey, thank you very much, and everybody, thank you. Yes, two parts remain now for this webinar: is the panel discussion, and then the questions and answers I would please ask the audience to send us questions and answers. We already have some of them. That would be the last session. Now we may start with the panel discussion. Just as an opening, what I would like to say here is that hearing and listening to my colleagues, I understood that we have a global tax regime, and it had to be simple and robust, easy to administrate. But when we have all these rules, in my understanding as a tax advisor, I really can see a lot of judgment. I see no clear pictures. So it's something that maybe we could discuss it as well. But really, for me, corporate tax residency is an issue, because either we go with the legal rules, directors, who are the director, etc., or we go with more economic rules, substance, and etc. It's hard. But anyway, that's the rules that we have to play around and to make sure our clients are in a good hands. All right, starting with the panel discussion. Andrey, if you allow me, I would like to start with you. I think always the question is the practicalities on what we said. So if you would like, maybe you can share with us the practice from the Russian tax authorities with respect to challenging the place of effective management. Just to repeat quickly the structure, there is this holding company in Cyprus, holds other companies located in the 4 countries that we mentioned. The problem is that the holding company has directors that are tax resident in those 4 countries, as we see here: Greece, Russia, Romania, and Polish, and the shareholders are there as well. So that's what is complicated the scenario, and we have these problems. So Andrey, very quickly, because we will have, we're a bit exceeding the time, please. Maybe if we can hear from you the practicalities from the tax authorities, the Russian tax authorities, regarding place of effective management.
Okay, yes, thank you, Demis. Yeah, I just already covered this aspect. Probably will briefly repeat and outline some key aspects. I think for Russia, this structure would be more likely reviewed by the Russian tax authorities, not in a way of, let's say, recognition of the place of effective management of the Cypriot holding company, relocation it to Russia, but again, the more simple exercise, but just try to disregard the substance of this holding company in the Cypriot territory. For instance, if the board of directors on the Cypriot side consists on certain, advocate, if the place of location of this holding company is certain advocate office in Cyprus where other holding companies are located, so then they would review the financial statement, assess the salary cost of such company, assess any other administrative costs of the company, which the Russian tax authority quite easily and effectively receive from the Cypriot authorities. Then the first conclusion would be if the authorities would be able to collect such necessary volume of documents to disregard the substance at the level of the Cypriot company and disregard the application of the treaty. Another potential approach, and we have several case laws on that, then the authorities compare the functions performed on the Russian side by certain, let's say, Russian located management companies of the group, etc., and also assess it's with the volume of activity performed abroad. So far, this practice is developing in favor of the taxpayers, not in favor of the tax authorities, because, as I mentioned, for Russia, the Russian national legislation operates not with the, let's say, day-to-day management, but with the volume of activities performed by official executive bodies of the foreign company. So in these cases, the authorities established that, a lot of day-to-day activities performed in the Russian side, but all official functions of the holding company were performed on the territory of foreign states, and on that basis, the court supported taxpayers in those cases.
Thank you, Andrey. Thank you. I think I wanted to hear as well from the other colleagues of Taxand about the practice in their own countries about the challenges that they see in a very quick way. All right, Christos, may I quickly get your view on that?
So typically the tax authorities, what they will do, they will most probably follow a strategic decision. So it's step one and step two. So the step one will be they need to consider whether the directors of the company, in fact, exercise management and control. So the answer could be either yes or no. If the answer is yes, then the next question will be from where do these directors exercise the management and control? And this case is that it does not necessarily where they meet, because, for example, they can meet electronically or they can meet once in Cyprus, but they can still make their decisions elsewhere. For example, I would like to say that how the tax authorities they will do that, they will first follow a substance over form approach, that this is the form viewing the bylaws, the articles and the memorandum of association of the company and shareholder agreements, who has legally the right to make decisions, and then they will go in depth and see in the substance approach whether they actually take decisions. Now, if the answer is no to this question, so the directors fail this test, then the next question comes, who takes the decisions? And typically in closely held companies that they are not widely held, so they don't have a lot of shareholders, but if they are low shareholders, usually those that take the decision are the shareholders. So the tax authorities will go and see who takes the decisions. And the next question is that if the persons are the shareholders, they will say from where do they take the decisions. And if they take the decisions not in Cyprus, then this company will fail the test. Now, to come to a practical example, what clients are doing right now today is that they either increase their substance in Cyprus and they relax their substance in other countries, or they move the companies from Cyprus elsewhere. So if this is a case, let's say, for example, a company moves from Cyprus to Romania, either by liquidation or redomicile or cross-border merger, anyhow, there is a commercial way to do that. When you have cessation of residence, there are 2-3 issues that you need to consider. For example, what will be the exit taxes from the departed jurisdiction, and what will be the step-in tax base in the landed jurisdiction in Romania, because in the near future, when you are going to sell those assets, you are going to realize a gain there. So it's very important to have the step-up cost. Also, you need to consider other tax attributes like losses, whether you can utilize any losses from the departed jurisdiction to the landing jurisdiction, or you need also to consider the timing, whether when it begins to be resident in another country, and if you are full year or partially year resident, whether you have double taxation, or when you want to take a tax certificate. It really depends from the domestic legislation of the country.
Christos, thank you very much. Sorry, but we are really running out of time. We have many questions to cover. Let me go to other colleagues as well. All right, with Greece, I just wanted to ask the question, and I would be very pleased if you can answer quickly. Sorry for pressing, but the time is pressing us. Okay, in Greece, we understand that there is a legal precedent or guidance by the Greek tax authorities concerning tax residency challenges when it comes to Greek holding companies. So what kind of challenges do you most encounter for your clients nowadays with the topic of tax residency? Is this an issue that you assist clients with managing in Greece, these issues?
So thank you, Demis. Indeed, in Greece, we have seen an increased demand for assistance lately in the context of mobility of foreign senior employees or company executives wishing to relocate to Greece and work remotely. This is due mainly to effective, efficient COVID response of Greece and also other reasons. And importantly, the Greek states adopted tax and other measures to attract foreign investments and the open call for arrival of foreign tax resident individuals. So this has been a key area of discussion recently, where we help our corporate clients to manage any associated tax residence risks and, of course, other tax risks. And in general, to put into place appropriate structures in order to be able to comply locally. So the questions of fact to be assessed are the type of activities and the duration of presence, as well as the overall corporate governance of the companies involved. Of course, what is more likely is that the challenge of tax resident of a foreign large corporation could be less relevant than in a case of a small management team, a small business partner. At the end of the day, in all these situations, as one would normally expect a cost-benefit analysis to be performed by the Greek tax authorities to see whether they would challenge a foreign entity's tax residence or perhaps make a permanent establishment assessment or transfer pricing assessment due to the presence of the executives in Greece. In a more general and not just tax context. However, as stated, we see that the Greek state is rather keen to attract into Greece investments and digital nomads rather than to focus on the tax residence issue. So corporate tax issues require a factual analysis and ad hoc solutions, so companies should consider these issues proactively.
Ioanna, thank you very much. I'm just going to Adrian and Paweł now. I think if you guys can share with us maybe the experience from the tax authorities in your countries and some tips that you would like to say for us that we are saying to clients. And Adrian, may I start with you?
Sure, Demis, thank you. Yeah, so just quickly to answer your question, as mentioned, the Romanian practice is rather limited when it comes to challenging based on the place of effective management principle, and we can understand why, because if we are to do that and bring a foreign company in Romania, you will get to tax actually is its net taxable base, which is not that interesting as compared to the situation where you can go and simply say it was put there for treaty shopping, if you want, and deny the applicability of the tax treaty. And in this case, you get to tax 16% of the gross amount of the payments which are made towards that jurisdiction. So again, as Ioanna also mentioned, it's a decision by the tax authority to be made based on a cost-benefit analysis. What we had in practice, just to give you a flavor, which actually in a way confirms what I just said, it was if I remember correctly, with a Romanian bank which had made a transfer of non-performing loans portfolio towards a Cypriot-related party. What happened next was that the Romanian bank remained the one to service the credit portfolio, meaning to follow up with the clients, collecting the payments of principal and interest and pay it further to Cyprus. And the Romanian tax administration simply said that, look, I don't agree with what you say here. I don't think Cyprus has substance. I will just act as if the Cypriot entity doesn't exist and as if the transfer of the loans didn't exist. So in this case, I will consider that the interest which accrued after the transfer would have accrued at the level of the Romanian company and applied corporate income taxation at its level. To conclude and just to wrap up, and again, it is actually in line with what Christos has mentioned. We will recommend our clients, and some of their already started to carefully review their structures, which were put in place several years ago. Some of them were put in place due to the fact that at that time Romania didn't have interesting or favorable tax system for the holding companies. Now it has favorable rules starting 2014 actually. So our clients started to review their existing structures, and indeed, as Christos mentioned, where they felt that the substance could be better documented in Cyprus, they did that. In other situations where they felt they didn't have, in fact, really much substance in Cyprus, they thought of how to transfer potentially the Cypriot entity to Romania, either with a redomiciliation, with the actual acknowledgement of a place of effective management in Romania, or how to even close the Cypriot entity from the structure by merging it into a Romanian company, or just simply going to a straightforward liquidation with it. So there are various ways in which the clients can look and take the next steps. Obviously, this depends on the specificities of each particular case, and this is our recommendation, if you like, that they should start looking carefully at their structures given this entire evolution of the international taxation climate. Thank you.
Adrian, thank you. Paweł, may we have your views as well on these kind of issues?
Sure, of course. In such structure, or Polish authorities or clients should focus on three different aspects. One is treatment of Cypriot entity in the context of treaty dual residency and or treaty protection, or being Cypriot tax resident against Polish tax resident, for example, on income from sale of shares. And that's one thing. The second separate discussion is actually on the passive income and the eligibility for the reduced rates resulting from the treaty. And third aspect is actually checking whether the Cypriot company is not a CFC company, which would mean that actually the shareholders' income tax result is just calculated as if Cypriot entity was not existing. And all those three issues are to some extent correlated but in fact the decisions or the level of risk will depend on slightly different factors. So first, dual residency and potential converting of Cypriot entity into a Polish tax resident. Not very common. In a nutshell, the discussion would focus on the actual day-to-day management and capacity of the Cypriot directors to take decisions. I mean, a real formal capacity and a capacity in a meaning of know-how, expertise, and actual actions, because the rest is relatively okay. So holding and finance and IP rights signifies a certain level of substance, which is typical if supported by this capacity of making decision and some, let's say, material characteristics as office, then probably dual residency would not be an issue. And in general, there is a low profile of authorities towards this at the moment. Second thing, so withholding tax issues, similar discussion, although then we would have to look what happens with the distributions, whether they're automatically distributed to shareholders or reinvested or used for other purposes. So this would be more like a substance analysis and beneficial ownership analysis. So here we always look at the actual use of the passive income, what is going up, what stays at the company. And the CFC rules, again, slightly different approach, but focusing on real economic activities of the holding companies. So again, actually substance taking decision, but analyzed from the slightly different angle. This is basically it. And again, repeating from Polish perspective, the main focus at the moment is withholding and analysis from this perspective. Dual residency on CFCs, there are far less cases and far less attention of authorities at the moment.
Thank you, Paweł. Thank you, everyone. Now we're moving to the last part of this webinar, which is the question and answers. There are many. I will try to answer them with my colleagues one by one, starting with the priority that came in. If we don't manage to answer some of them because we are running out of time, please send it to us, and we're happy to reply back to you. All right, starting with the first one. I think this is addressed to my Greek colleagues, although it seems also general. So the first question is, good evening from Athens. Hello. I believe that the tax residency of a legal entity should be determined by the whether or not it has physical substance in the country in which it is established and disconnected from where the tax residency of the manager is and from where he operates. So if I understood correct the question, there is a suggestion here that they would like us to comment on, that the tax residency of the companies should be determined by whether in the country where it is established and not where is managed.
Yes. Yeah. So I will put in place my remarks and pass it on also to my colleague Daphne. I agree with the theoretical aspect of this approach because, as we mentioned, from a Greek perspective, there's no much precedent. And so it hasn't been up to date, the first task in the tax authority's agenda, the matter. If by physical substance we mean premises, equipment, bank accounts, yes, I agree that they are key factors to determine substance, let's say the tax residence. But as we read the article and the very little guidance we have in place, it is not just these elements, but it is firstly the place that decisions are taken, the day-to-day management, and moving on, and potentially also examining the residents in conjunction with the other factors. So it is not the first thing to examine the tax residence of a manager, but could be taken into account only, let's say, at the end of the day, if the rest of the criteria and information are not sufficient to this end. Daphne, I don't know if you have any comments on this?
Yes, just very quickly. Thank you, Ioanna, and hello, everybody. You know, physical presence is a very good point because it's a much simpler rule to administrate, much easier. But as Ioanna said, the rules right now are not, you know, they refer very much to the place of where decisions are actually taken. And let me also, you know, point out that, you know, this physical presence concept going forward, we're mostly likely to see much less of it. Because, you know, as far as international tax principles are involved and, you know, the current nexus, which is physical presence in a country in order for a company to be taxed there, I think this may become less important in the future, you know, as the international tax principles follow along and adjust to the digitalization of the economy. So maybe this is something that we're going to see, you know, physical presence less and less in the future.
Thank you, Daphne. Thank you, Anna. Moving to the second question. Sorry, Daphne, did you finish or I interrupted you?
No, I'm done.
Okay.
Thank you.
Thank you. Thank you. All right. Second question. Yes, one second. Okay. What is changed in the tiebreaker rules post 2014? What is the possible changes we can foresee post BEPS? Another very interesting question. Yeah, may I ask someone just, you know, Adrian, you want to comment that?
Yes, Demis, yes, sure. I will try to answer, actually, to present my point of view. I have mentioned already earlier that indeed the new rule for the tiebreaker starting BEPS or following BEPS is now to look at a mutual agreement procedures between the two states which are involved in the particular discussion. So the place of effective management doesn't necessarily remain the tiebreaker, but we now look at from a different angle. This would be actually the change to respond the first part of the question. And secondly, just to give the example of Romania, Romania is now signatory of the multilateral instrument for the implementation of the BEPS, but it did not yet ratify it. So that means that the double tax treaties of Romania are not yet directly impacted by the provisions in the multilateral instrument, but Romania has at least taken some particular steps that I've mentioned in terms of negotiating some of the new double tax treaty in this direction, where the tiebreaker should be the mutual agreement procedure. So just to answer Mr. Gupta's question, it may be also an approach to look on a country-by-country basis to determine what is the actual status for them in implementing the multilateral instrument, and see from there how the entire treaty network of that country will be impacted by that.
Thank you, Adrian. Next question, this relates to a country specific, to Cyprus. So question, Christos, what do you mean by statement, business increase substance in Cyprus? What is current common practice in Cyprus with regards to the matter?
Now, to answer the question about substance, I would say that substance is all about people. It's all about people taking decisions, actual decision, and taking risk. It is less about having an office, having a landline, having a fax machine, and so on. So this really depends on the activities of the company and what type of business you are doing. So if you are a big MNE that you have a lot of affiliates, that you are providing various loans and so on, and you need to have decisions every day, you need more people to do that. But if you are a simple holding company, having one private equity shares on your balance sheet, it means that you need to declare one dividends once a year, or decide whether you will sell this private equity once a year. So it really depends on the type of activity of the company. This is the first step. And the second step is whether this company has everyday activity, what kind of risk it takes, what kind of functions that company has, and whether a lot of people are needed in order to take these actions. If this is the case, then you need to increase your substance. If this is not the case, then you don't need to increase the level of substance. So just to conclude my question is that it's all about people taking real decisions, doing real functions, and owning real assets. Demis?
Thank you, Christos. Next question. How are director decisions taken by writing viewed? Will the decision be deemed made in the jurisdiction where the writing is executed? What if executed in more than one jurisdiction? Andrey, maybe you would like to comment on this question?
Well, yeah, I just already answered. I mean, from the Russian perspective, it's quite obvious that the key criteria would be the place of location of this decision-making person, not, let's say, if I understand correctly, the question of the place there, let's say, such a written decision is executed. And this is mentioned, for instance, in the Russian legislation specifically, that any administrative management assistance with respect to such activity as such does not create a place of effective management and should not be considered for these purposes.
Okay, all right. Maybe Andrey, you wanted just to comment on this again. I mean, is it an easy test to understand who decided and who didn't decide on a decision? I mean, from your perspective, from your practice?
Well, it can be. It can be established. For instance, in Russia, the tax authorities very often practice such way of tax audit as a questioning of employees of the company. So it's probably difficult to establish. Then you talk about some written correspondence. But if you invite to the tax office or especially to the police office certain group of employees and then question them within certain time, everything would become clear.
Excellent. Thank you, Andrey. Okay, the other question, Paweł, if you would like to comment, is there any permanency time requirement for the poem for the effective management, What if only few decisions are taken in country A from time to time, and most of them in country B?
As usual, the answer starts with that's a very good and tricky question, actually, because of course, at least in Poland, as far as I understand, in most of the countries, there is no strict rule on this, and we always analyze it on a case-by-case basis. Any advisor would prefer a clear-cut solution that decisions are taken in country A or in country B, because this is simple, but then the clients are not asking questions for simple situations. So trying to answer, then it really then have to be weighted and decided to what extent the fact of taking decision in some other country or the gravity of or number of such decision or gravity of such decision is such that we actually moved to another one. In Poland, certainly there is no practice or whatsoever which could, let alone rules, which could give a guidelines. But what I would certainly say, and we certainly take such position, and in some interpretations we see that this is accepted, that the mere fact that some decisions are also taken someplace else, I mean in other country, does not necessarily mean that we lose the residency. This is for sure. It's just a matter on a tiny detail what it means some. And this is of course a case-by-case basis, unfortunately.
Yeah, I agree, Paweł. Quite a difficult question, to be honest, from my perspective as well. Okay, sorry, I think the time, we exceeded the time. So if you allow me to wrap up, and I would like to thank you all for turning into today's session. We hope that you found the webinar useful and insightful. Please keep an eye on your inbox for invitations for future Taxand webinars. As a reminder, speaker profiles, as you can see them here, can be found on the last slide of the presentation. But if you have any specific queries, please email taxand@taxand.com and you will be directed to the appropriate contact. Enjoy the rest of your day wherever you are in the world. See you soon.